Hello and welcome to a brand new episode of Eating Markets PMS Talk, a show where we discuss about opportunities as well as challenges faced by the fund managers in the popular space of ultra HNI investing. Well, my name is Chandra and then today we have with us a very special guest, Rajesh Kothari, who is a managing director at AlfAccurate Advisors Pvt Ltd. Welcome to the show, Rajesh.
Thank you very much.
Thank you for being part of the show, Rajesh. Now, tell us something. You have an experience of more than 2 decades. How is the environment changing for the PMS industry here in India?
Well, I think there is a significant change. I think the entire industry, if I can use the word transformation, probably would be the right word. Because I remember way back in 2009, when I started my PMS, I had to actually explain what is a full form of PMS, the portfolio management services.
Absolutely. Yeah.
And today, thanks to the regulator, the way in which they have changed the entire rules and regulations for the industry, which made it very what I would say trustworthy, comfortable from the investor's perspective to invest into PMS as a structure, just like a mutual fund. So today, PMS is like everybody considers mutual fund, PMS. Those are basically accepted terminology. People understand what basically PMS is all about. So I think it is a sea change in last 10, 12 years.
Right. Now, Rajesh, also tell me, yes, definitely you quoted that there's a sea change. Now, where do you see the PMS industry and the markets, especially in the year, you could say the new financial year, and definitely in years to come, if you're talking about financialization of saving that has been happening and a lot of money, and PMS has become a popular, source of investment as well. So, where do you see the industry heading?
I think the industry is a great future because, unlike mutual fund industry, PMS industry is more oriented towards HNI side of it. I don't know whether the HNI is right word or not, but yes, it is for the higher ticket compared to retail kind of thing for mutual fund. And one very important advantage what PMS offers to the investor is that your behavior impacts your performance.
Absolutely.
Unlike mutual fund, where somebody else's behavior can impact my performance. So let me give one line explanation of this. Say for example, let's assume market is down 10%, and on that day you are holding your PMS account, and let's assume Infosys is down 10%, for example. And if you are doing top up in PMS, and therefore I'll be investing into your account to take advantage of the downfall of the particular stock.
True.
Whereas in mutual fund, suppose the investor is very strong, but some retail investor, for example, he is making a reduction, and that outflow is greater than inflow for that particular fund, he has to sell Infosys on that day, although the markets are down. Correct? That's the single biggest difference, if you ask me, between a mutual fund and a PMS. So I think the future is bright for both. I'm not saying I'm not against mutual fund for the entire industry, because finalization of the savings has already started. Equity as a culture is improving, and I think as the per capita income, affordability, awareness increases for PMS, I think the size is going to probably become 2x, 3x, 4x, 5x, 10x over a period of time.
Absolutely. No, in fact, I was doing a bit of reading, and what I found is AlfAccurate Advisors it's one of the best in the industry, and it follows the principle of protect capital and create wealth. Now, tell us something more about this methodology as well.
Very good point. So that's our investment philosophy: protect capital and create wealth. Because when it comes to equity market, everybody first question what comes to your mind: kitna paisa banega?
True.
But
I know.
More than important kitna paisa banega is how much you make sure that you don't lose money, because equity market is also underlying risk. And let me tell you, 100 to 50 is a 50% decline, but for 50 to go to 100, it is a 100% increase.
Okay. True.
So less you lose, that by default will allows you that when the market again starts doing well, you actually make much more than that. Right? And therefore, the first important thing when we manage money, it is the hard-earned money of our clients, we are just trustees. We need to make sure that we lose less. And of course, we create more alpha, and that's wealth creation. The combination of it, if you do both, every time lose less in a down market and go up in a rising market, if you keep doing that consistently, and that's what we've been doing, then over a period of time, the kind of wealth what you can generate is a sizable, right? And therefore,
Absolutely.
that sutra, that mantra is very, very important.
No, absolutely. In fact, you've pictured it perfectly, and you've put it across perfectly that it's important to save capital and at the same time, hedge your risk as well. Now, let me also come to another point. Now, AlfAccurate Advisors IOP PMS, the flagship product has in fact delivered 17% CAGR kind of return in the last 13 years. How you are able to beat the benchmark return consistently, and is it the stock selection or better risk management that has actually given you that kind of edge?
I think the three factors which has worked for this kind of a what I would say superior risk adjusted returns, the consistent performance. The first important thing is risk management. Right? So we are pioneer of 50 stocks diversified portfolio in PMS industry in India.
Right.
We strongly believe in diversification because that's the only free lunch available in finance. There is no other free lunch.
True.
Second very important is we are agile. The agility is very important. Focusing not only on what to buy, but equally focusing on when to sell is a very critical. The disciplined exit strategy that basically makes you sure then you always have a portfolio of companies which is the underlying growth. And third, of course, important thing is what we buy. And here we have a very effective 3M approach, the market size, market share and margin of safety. So just to put in nutshell, these three things combined, buying businesses which are market leaders with the best of the management, best of the governance, best of the financials, and best of the growth. Buying 40 to 50 such companies, diversification to reduce the risk, and then making sure you exit those companies, correct, when you think the business cycle is not going to be in your favor. It's a combination of that approach which results into the consistency of the performance. Through last 13 years, 1 crore has become roughly about 9 crores thanks to that approach.
Absolutely. In fact, staying focused and staying with your system definitely keeps the ball rolling, or it helps in compounding the wealth. Now, you also have small and mid cap thematic funds as well. So how do you pick small and mid cap stocks for your portfolio? And is this segment an attractive space for the next financial year as well? Now, why I say that is because, if you look back, especially the mid and small cap stocks are still beaten down, even though we saw some bit of recovery happening with respect to Sensex and Nifty. So what are your views for the broader markets?
So, we launched this AAA Budding Beast, which is a offering in mid and small cap space about, 2 years back. And in last 2 years, this PMS has delivered about 22% compounded annualized returns compared to benchmark returns of 14%.
Right.
Our thesis of identification of stock remains the same.
Okay.
We actually do not buy any mid and small company by revenue or profit size or market share. Something completely different I'm now telling you.
Absolutely.
We buy the companies which might be mid and small cap by market cap. But company should not be small when it comes to its market size, market share, or the net profit. Let's say, for example, we have identified roughly about 25 to 30 sectors in India where the companies are oligopolies. They have zero debt balance sheet. All our portfolio companies, most of them are zero debt or under leverage. And at the same time, there are only one or two companies in that sector. Like for example, plywood sector. The entire sector is classified as a mid cap or small cap. Or for example, luggage sector. There are only two companies in India in listed space, and both are mid or small cap. But the companies are not small. Very important. So in mid and small cap space also, we have kept our stock selection approach, 3M, our thesis, our stock identification approach remains the same. And then on top of it, we make sure that, again, buying 40-50 companies in our AAA Budding Beast. Every company, generally, what is the problem in mid and small cap? The problem in mid and small cap space is Generally, people buy micro companies. We don't do that. Our average weighted market cap is roughly 22,000 crores. 22,000 crores our average weighted market cap. So we actually buy reasonably large size of the company, in terms of the revenue, profit, market share, and so on and so forth. And then again, we are making sure these companies are basically almost debt free. They have high underlying return on net worth, and of course they have a high underlying earnings growth. So those characters remain the same, whether it is our PMS Plan 1 or PMS Plan 2 or IOP or focus on budding business. The investment thesis remains the same. Coming to your second part of your question, what is our view on this space? I think the valuations have turned very attractive.
Yeah.
If you look at the mid and small cap valuations compared to last 10 years, the mid and mid cap is right now trading at below its 10 years average valuations. And let me also tell you one important thing, is that the return on capital employed of small cap index has actually improved from 12% to 18% in last 10 years. So earlier, small cap index used to trade at say 15-20% discount to Nifty. But now the return on capital employed profile of both Nifty and mid cap and small cap, all three, is almost similar, around 17 to 19%, very healthy ROC. And therefore, I don't think they will now trade at 20% kind of a discount to Nifty, which it used to trade at 10 years back.
Right.
So I think the valuations are reasonably attractive. The growth profile is, of course, a little bit better compared to Nifty, because mid-sized companies definitely can grow higher compared to the mega cap companies, top 50 or top 100 companies of the country. And on top of it, their balance sheets are also now much healthier share. Combination of these three things makes me believe that we are at an attractive valuation point, and from here on, if one has a little bit long-term view, because mid and small cap has a little bit more underlying volatility compared to large cap, therefore you require a little bit longer time horizon, then I think you can make reasonably decent money over medium to long term.
Right. In fact, the secret to wealth creation is the stock selection, which you've already explained in the first part, that how to pick stocks, especially when you're dealing with the small and the mid cap space. I'm sure our viewers would definitely relate to this problem which they must have while they are selecting their stocks at that point in time. Now, you also offer STP and SIP option for all PMS plans. Now, how does this help in building wealth over a period of time?
Basically, we have seen that irrespective of whether the investor is small, mid or large, at different point of time they get liquidity.
True.
Okay? Yeah. So definitely this kind of option allows you to invest your money at different intervals. Secondly, at times markets are volatile, and I always tell my investors, take volatility as your friend, use it to your advantage. Right? So for example, last 3-4 months or during even Russia-Ukraine war, we advise many of our investors to do staggered approach. So if you use STP, you are actually basically you are into the market and still you are not fully invested into the market. You have some dry powder, and when markets are volatile, markets are uncertain, it gives you mental peace. At the same time, it gives you advantage of averaging it out if market becomes unfavorable compared to your initial purchase. So instead of putting 100 rupees at one go, I said, okay, let me spread it over 3, 4, 5, 6 months, and that actually allows me to stagger my investment and to cut through that noise, that volatility of that time period, which is generally critical from mental comfort perspective, over 3-6 months. So these are really very nice options from investors' perspective.
Right. Now, in fact, let me also come to the current news. In fact, the new tweaks which are being introduced by the government in the finance bill. So, how will that impact your investors or the PMS industry at large?
Well, I think this government is basically what I would say any gaps which are there from the tax arbitrage perspective. I think this government is closing all those gaps. And with this new announcements of the debt product, and before that it was MLD, and now then insurance, and now the debt mutual fund, very clearly there are only 1 or 2 or 3 products which are efficient from the taxation perspective, correct? Equity, therefore, it becomes favorable for equity, correct? And therefore, to that extent, for our firm in particular, because we are only into equity PMS, and for my investors, it is basically net positive for us because earlier there was an advantage, tax advantage, there was the arbitrage, but now now there is no such tax advantage. So to that extent, equity culture probably will further, it will improve the equity culture in the country. So net is good for us.
Right. Now, any message to investors for FY24?
I think message to investor is Rome is not built overnight. It takes time. If you keep watching the portfolio, whether you are done direct investment or indirect or anywhere else third party product, on a daily basis is not going to help you. You need to keep patience. In fixed deposit, you keep 10 years patience. In gold, I think most investors, they take 20, 30, 40 years. I don't know how many years patience they have in gold. But when it comes to equity, every month there is a fact sheet, there is a reporting, there is a transparency. Make sure that you don't take it to your disadvantage, take it to your advantage.
Right.
Give a little bit longer time period, 3 years, 4 years, 5 years. And then of course, monitor your investments on periodic basis. It is a great wealth creation asset class, and keep faith on equity as an asset class. It generates huge wealth. Look at US market. Look at how US market has changed the wealth of US citizens in last 10, 20, 30, 100 years. And look at India, the penetration is still very low, despite all the efforts by exchanges, regulators, education, awareness. We all are doing so many things, but yet, where are we in terms of penetration? Nowhere, right? We have miles to go. And at times I feel bad that, the Indians are actually not participating fully into this beautiful wealth creation journey. A country which is going to grow at 10, 11%, from 10th largest, then 5th largest, going to become now 3rd largest very soon. It gives a huge option of wealth creation to the citizens. You just require a little bit more patience, and of course invest wisely. Don't speculate. Restrain yourself. At times, get a little bit disconnected. Don't believe into the WhatsApp university. Keep faith. If you're investing in good companies, just keep faith, and it will pay you off in the long run.
Right, absolutely. In fact, rightly said, keep faith in India, and that's going to turn out to be a wealth creating opportunity, and stay put in equities. Well, on that note, thank you so much for your time, Rajesh, and that's all for now. But do stay log on to etmarkets.com for more on news, business and economy. Thank you so much for your time, Rajesh.
Thank you very much for providing this wonderful opportunity, and I must congratulate you for starting this great initiative. I think it was the need of the hour, and I'm sure it will help your viewers a lot in taking the informed decision and improving their knowledge as well on the capital market. Thank you.
Thank you so much for your kind words, Rajesh. Thank you so much.